Hello and welcome to the show. I am Puneet Wadhwa and today we have with us Mr. Prashant Jain. He is the CIO at 3P Investment Managers. Welcome to the show, Prashant. Let me begin by asking you the outlook for the next 1 year. How do you see the Indian markets and global play out in the backdrop of whatever is happening globally in terms of bond yields, in terms of what the central banks may do, in terms of where the oil prices are?
Sure, Puneet. I think that's a very pertinent question. I think the outlook for the economy is very strong. I think mainly driven by improved outlook of service exports, driven by acceptability of remote working, and we see the number of jobs in India being created at a very fast pace. And India is also seeing increased traction in manufacturing investments. So I think the economic outlook is quite strong. The macroeconomic parameters are very good. The bank NPAs, bank balance sheets are extremely healthy. Corporate leverage is extremely low and corporate profitability is at very healthy levels. Coming to markets, I think these are fairly valued markets, and Nifty has underperformed nominal GDP for last 2 years. CAGR has been 5%, and the excesses therefore have moderated. I see some excess in the small mid cap space. So I think these markets are very fairly poised. Thus far, the rise in US bond yields has not impacted the Indian bond yields or markets. And the gap between US and Indian bond yields has actually come down to 2.5%. It used to be between 4 to 6%. I don't think it can possibly go any lower because the gap between India and US inflation is also now close to those levels. So my view is that if bond yields in US go up further, then I think it will impact Indian interest rates as well. And any further spike in US yields could bring one more round of FII selling. And while FII sales thus far have been absorbed by a very healthy local flows, but a knee-jerk reaction cannot be ruled out. The near-term outlook for market is probably a range-bound one with some risk of correction should US yields spike up. But longer term, I think these markets should deliver. Nifty should compound around 12% CAGR, medium to long term.
If the bond yields are going to rise, hypothetically, could the next 1 year be belong to the debt market investors as compared to the equity market investors? And what kind of returns should one expect from equity markets versus the bond markets?
No, I think, as I said, should US yields rise further from where they are, I would expect the Indian bond yields also to rise in tandem. And so if you invest in bonds, if US yields rise, that the near term, there could be some depreciation in bond prices. But longer term, I think the returns will be closer to the bond yields. I think you also have to take into account the much higher taxation on fixed income versus a concessional taxation on equities. And I think therefore the risk reward for a medium to long term investor, to my mind, is more towards the equities.
What are your overweights and underweights as things stand, let's say from a year's perspective?
The consumer sector, both the staples and discretionary, is what is expensive. I find bulk of the other sectors to be fairly valued, and there is some undervaluation to some extent in the banks and in the power utilities space.
In terms of market valuation, Prashant, PE is the go-to barometer. When we say that the market excesses have been removed, which means that the price-wise there has been a correction. But a lot of this was to be supported by earnings coming through. What's your call on earnings given the macro headwinds in India and abroad? And do you think that they could probably be trimmed further as we go ahead over the next few quarters?
The earnings have been very strong last few years, and India's corporate profits to GDP that had fallen to around 1% has recovered closer to 4.5%. I think margins are at very healthy levels across sectors, to my mind. And going forward, I would expect earnings to grow around 15% CAGR. And I don't see too many risks to that at this point of time.
When do you think the domestic mutual funds and the retail investors will start to take the risk off the table?
No, I think, Puneet, I would say that domestic flows are quite secular and acyclical, and we have, I mean, if you look at the SIPs, it's crores of investors who are investing 3,000-4,000 rupees a month. The flow of EPFO, NPS, the flow towards through insurance companies, these are quite structural. And interestingly, it was the first time in last 20 odd years when in 2021 markets, I mean, foreigners sold almost 2 lakh crores worth of equities. The markets did not fall at all. So I would say the vulnerability of Indian markets to foreign outflows that we used to witness in the past, we are far less vulnerable now. A small correction, a knee-jerk reaction cannot be ruled out, but I think the recovery should be extremely fast. Equities have over time emerged as a core asset class for households, and the percentage of flow of savings going towards equities continues to rise.
How does one position oneself ahead of this big event, state as well as the general elections?
So I always jokingly say that no elections are a far bigger risk than election outcomes. So I don't worry too much about election outcomes, and that's because irrespective of changing governments, the broad direction of reforms has stayed constant, and you have not seen any important policy reversals in India, even if governments have changed. So I feel that markets have a closer relationship to valuations and to profit cycles, corporate business cycles, than to elections. Having said that, a knee-jerk reaction cannot be ruled out if the election outcome is not to the market's liking.
Thank you so much, Prashant, for your time today. We hope to see you soon.